France just pulled its gold out of America. Gold got smashed right as the Middle East started burning, and the public was handed one of those explanations, so insulting that only a central bank could say it with a straight face and expect normal people to nod politely and move on. That is where I want to begin, because when an event happens that should have pushed gold higher and instead gold gets hammered, that is not the moment to repeat old textbook lines about safe havens and diversification and how markets digest information efficiently over time. That is the moment to stop, get quiet, and ask a much harder question: who actually sets the price of gold? Not who owns a few coins, not who posts on the internet, not who talks loudly about monetary collapse. Who sets the price? Who moves it? Who gets trapped when it falls? Who gets to buy after the trap closes? And who is quietly pulling physical metal out of the system while the public is still staring at the paper quote on a screen and wondering why the thing they were told would protect them is suddenly bleeding. That is the real story here, not gold the idea, gold the mechanism, because if you understand the mechanism, the move stops looking random. It starts looking familiar, very familiar. And I have spent enough years around markets to know that when something important behaves the wrong way, at exactly the moment the public expected it to behave the right way, there is usually a structural reason sitting underneath the price that matters more than the headline itself. War breaks out in the Middle East. Oil jumps. The Strait of Hormuz sits there like a loaded gun aimed at the world's energy arteries. Inflation risk rises. Safe haven demand should rise with it. And yet gold gets hit hard, fast, and in a way that looked almost offensive if you still believe the market was simply some clean mirror reflecting common sense. That is the bait. That is where the ordinary investor gets hurt. He still thinks price is mainly a truth signal. It is not. Often price is a pressure signal, a liquidity signal, a leverage signal, a positioning signal. And when the market around an asset is built more on paper than on physical transfer, price can tell you far more about who is being forced out than about what the underlying asset is worth over the longer horizon. That is the first thing I want you to understand. Gold did not get hit because all at once it stopped being gold. It got hit because the mechanism around gold is not mainly a physical jewelry market or a simple ownership market. It is a paper market, and that distinction changes everything. Most people think they are looking at the price of metal. Very often they are looking at the price of leverage applied to paper claims on metal. That is a different thing. So let us walk through the crime scene slowly. Gold runs to new highs. Then, in a short stretch, it gets slammed. Not drifted lower, slammed. And the timing could not have looked more absurd if you were still using the old mental model. War should equal gold higher. That is the formula. That is what the public was taught. That is why so many people got blindsided. But the market does not care what the public thinks should happen. It cares about structure, it cares about leverage, it cares about margin. And once you understand margin in a paper market, the whole thing begins making a different kind of sense. The exchange that matters here is COMEX. That is where the paper gold game is played at scale, not where most physical investors store bars, not where central banks make speeches, where futures contracts trade, where paper claims dominate the visible price. And this is the part the average person never gets taught clearly enough. Most gold futures contracts do not end with somebody taking delivery of actual metal. Most of them are just directional bets. Price claims, exposure claims, leverage claims, people betting on what the number will do, not hauling home bars. So when television says gold is down, what it often really means is the paper structure tied to gold is under pressure. That pressure can absolutely move the visible benchmark that the whole world then treats as the gold price. But the paper quote and the physical reality are not the same thing. They can travel together for long periods. They can also diverge in spirit, even while the headline price looks authoritative. That is why I am always suspicious when the public speaks about gold as though there were only one market. There are at least two: the paper market that sets the screen price and the physical market where serious institutions decide whether they want the actual metal inside their own walls. Those two markets can tell very different stories at the same moment. Now here is where the mechanism gets ugly. The exchange changed the way margin worked. That sounds technical. Good. The most important financial crimes of every era are usually hidden inside words most people find too boring to question. Margin is collateral. It is the money you must post to keep a leveraged position open. Raise the margin requirement and you make the trade harder to carry. Raise it again and you start squeezing people. Raise it repeatedly in a short enough period and you no longer merely adjust for volatility. You create a structure where weaker hands can be forced into liquidation, whether or not the long-term thesis behind the position changed at all. That is exactly why margin changes matter so much more than public rhetoric. The public listens to speeches. Professionals watch collateral requirements, because collateral decides who survives long enough to stay in the trade. And survival is half the game. That is what younger investors almost never appreciate. Being right is not enough. You must remain solvent long enough for rightness to matter. That is true in stocks, true in real estate, true in credit, and brutally true in futures. So when margin gets hiked, the weak hands are not debating philosophy. They are looking for cash. If they cannot produce it, they sell. And if enough of them are on the same side of the trade, that selling becomes its own event. Price drops, that triggers more margin calls. More people are forced out. The price drops again. Now you have a liquidation cascade. The ordinary person watching the chart thinks the asset itself must have become less worthy. That is not necessarily what happened. What happened may simply be that the financing structure around the asset became more hostile faster than the weaker participants could adapt. That is a very different diagnosis. One is about value, the other is about force. Modern markets are full of moves caused by force that later get misinterpreted as statements about value. That is one reason the public gets so confused. They are reading a chart as a verdict when the chart is really a record of pressure. Now ask the next question, who can survive a margin storm like that? Not the small trader, not the lightly capitalized fund, not the retiree playing with leverage because the story looked obvious. The people who survive are the institutions with deep enough balance sheets that a margin hike is an irritation, not a death sentence, and once the weak are flushed, who gets to buy what they were forced to sell? The same institutions that could survive the storm in the first place. This is one of the oldest tricks in finance. Change the conditions, stress the weak, trigger liquidations, then buy from those who no longer have the luxury of conviction. You do not need a grand conspiracy memo to understand how incentives work. You only need to follow the structure. Who benefits when weaker longs are forced out? That is the better question. Now let us add the second layer, central bank and sovereign selling. Again, most people hear this and immediately drift into simplistic thinking. If a country sells gold, then surely it must think gold is bad. No, countries sell what they can sell, and gold is highly liquid. If war pushes oil up, if energy import bills rise, if a currency starts weakening, if a central bank needs dollars, or simply needs to defend the domestic system, gold can become the cleanest source of immediate liquidity. That does not mean gold failed. It means gold was one of the few things liquid enough to help. That is a very important distinction. Turkey is one example from the source document. There may be others like it. The key point is not to build a fantasy around one state actor. The key point is to understand the pattern. War creates energy stress. Energy stress creates funding stress. Funding stress creates demand for dollars. The most liquid reserve assets get sold. That selling lands into an already fragile paper market. Then the market interprets the price decline as a philosophical statement about gold itself, rather than as a mechanical consequence of who needed liquidity and how fast. That is how the public gets separated from the truth. They see the move, they do not see the chain. Now, add the dollar. This is where people who claim to understand gold often become strangely lazy. Gold is not only a metal story, it is also a currency story. A stronger dollar can weigh on gold in the short term because gold is priced in dollars, and foreign demand feels the pressure first. If war drives people into the dollar because U.S. debt is still treated as the global fallback instrument, and because sufficiency or relative strength makes the United States look safer at the margin, then the dollar can rise even while the world looks uglier. That stronger dollar then becomes another force against gold in paper price terms. This is why you must stop asking only, should gold go up in crisis? That is too childish a question. The better question is, what kind of crisis, through which channel, with what effect on the dollar, what effect on rates, what effect on collateral, and what effect on who needs cash first? Now you are asking adult questions. Now you are inside the real game. The war raises oil. Oil raises inflation risk. Inflation risk hardens the Fed. A harder Fed supports the dollar. A stronger dollar pressures gold. Margin hikes intensify the selling. Central banks or stressed actors liquidate gold because it is liquid enough to use. That is the loop. Once you see the loop, the move stops feeling impossible. It starts feeling engineered by incentives, even if you never prove some cartoonish single master plan that is good enough for me. Because markets are rarely moved by one villain. They are moved by a structure in which the powerful benefit from exactly the kinds of responses the rules make likely that is often worse. Now I want to talk about France, because this is where the story shifts from price action into trust. France moved a large amount of gold out of the United States and replaced it with gold held in Europe. The official explanation, as the source lays it out, is the sort of thing central bankers say when they want you to stop asking the obvious question. The old bars were inconvenient. Not up to the new standard in practical terms. It was easier to sell and repurchase compliant bullion closer to home. Maybe, maybe not. I have been around institutions too long to take such explanations at face value, when the action itself is so revealing, when a major holder says, in effect, we would rather have our gold under our own regional control than keep trusting the old arrangement. I do not obsess first over the wording of the press line. I ask what the action signals, and the signal is simple. Trust is shifting. That matters, not because every ounce must now flee New York tomorrow, because trust is the foundation under every reserve system. The gold market is not only a market, it is also a confidence structure. The dollar system is not only a set of transactions, it is also a confidence structure. When large states quietly alter where they want real metal held, that is not a small symbolic move. It is a clue. And when another large holder begins debating whether to do the same, it becomes more than a clue, it becomes a pattern. This is one reason I always tell people to watch what central banks do, not what they say. Official language is written for calm. Actions are written for protection. And protection tells you more. You do not move reserve assets around because nothing matters. You do it because something matters enough that you no longer want convenience to outrank control. That is the real message. Now let me be careful here. I do not need to claim that every bar was missing or that every vault story is a lie. Those are entertaining arguments for men who enjoy outrage more than discipline. They are not necessary for the core insight. The core insight is already strong enough. Large holders are showing less blind trust in old custodial arrangements than the public assumes. That is what matters. And if trust keeps slipping while the paper price remains controlled by leverage and margin dynamics, then the divergence between the visible gold market and the strategic gold market becomes more important, not less. Now we move to the part of the story the public almost never sees. China, not the retail Chinese buyer buying a few small bars, the institutional and sovereign side, the insurance channels, the broader appetite to hold more gold over time. This is where the future matters more than the last ugly month on the chart. While Western paper holders were being shaken out, China was not learning that gold was useless. China was learning, again, that weakness in the quoted price can be used to build position. This is how serious entities behave. They do not ask only, what did it do this week? They ask, what is the strategic role of this asset over the next decade? And are we being offered moments of forced weakness by a paper market structure that has little to do with long-term scarcity? That is a much better question. If large insurance pools are permitted or encouraged to put a portion of their balance sheet into gold, that matters. It matters because insurance money is patient money compared with speculative futures money. It matters because strategic allocation is not the same thing as late cycle chasing. And it matters because the East has been much less sentimental than the West about the difference between paper price and physical ownership. The West often treats gold as a trade. The East more often treats it as reserve architecture. That is a different religion. One is asking how much it can go up next. The other is asking how much system risk sits inside, not owning enough of it when confidence in paper arrangements starts weakening. That is why I say the Western public and the institutional East are often playing different games with the same metal. The West loves gold stories when the chart goes vertical. The East loves quiet accumulation when the story looks temporarily ugly. Those are very different instincts over long periods. I know which instinct I trust more. Now let us pull back and ask the larger question. Was gold crashed on purpose? That is the phrase in the title. And titles are meant to sting. My answer is that the important thing is not whether one secret committee sat down and said, "Let us crash gold on purpose." That is how amateurs think about power. Power is usually more banal and more effective than that. The rules were changed in a way that magnified forced selling. The most fragile participants were the ones pushed out. The dollar dynamic worked against gold in the short term. Sovereign liquidity needs added supply. The institution strong enough to survive the cascade got to operate on the other side of it. If you want to call that engineered, I understand why. If you want to call it structural, I am satisfied with that too, because the effect is the same for the ordinary investor. He gets separated from the position at the moment. His patience mattered most. And that, more than semantics, is the real issue. Now I want to give you the framework for what comes next. Not because anyone can predict the exact path, because good investing is not prophecy, it is structure. The first thing to watch is the divergence between paper weakness and physical behavior. If delivery interest remains strong, if central banks and long-horizon institutions keep accumulating while the visible price remains soft, that tells you the paper market is doing one thing and the serious holders are doing another. That gap matters. The second thing is to watch the dollar and rates honestly. If the dollar stays stronger than people expect and real rates remain high, gold can stay under pressure in the short term much longer than the public wants. I have no interest in flattering anyone here. Gold can be right long term and still humiliating in the interim. That is why owning gold with leverage is such a dangerous game. It turns a strategic asset into a tactical vulnerability. The third thing is to watch official trust behavior. Reserve repatriation. Custody shifts, central bank buying, changes in how large non-Western institutions are allowed to allocate. These things matter more than 10,000 retail hot takes because they are the strategic layer underneath the visible market. And then there is one more piece, your own behavior. This is always the part people want to skip because it turns the spotlight back on them. If you own, why do you own it? If the answer is because it looks strong and everybody was talking about it, then you do not own an asset. You own a mood. If the answer is because you believe the long arc of debt, dollarization pressure, reserve diversification, institutional mistrust, and geopolitical instability supports a strategic role for gold in a portfolio, then a short-term engineered or structural flush should not produce the same panic. One answer leads to forced selling. The other leads to patience. That is why clarity of purpose matters so much. The asset is the same, the owner is not. I have always said that an investor who does not know why he owns something will be shaken out by the first ugly move that contradicts the shallow story he attached to it. That is what happened to many gold holders here. They did not own a reserve asset in their minds. They owned a promise that war automatically means instant upside. That is too simple a promise for a market this political, leveraged, and manipulated by structure. Now let me end as plainly as I can. The gold crash did not prove gold was dead. It proved the public still does not understand how the gold market actually works. The visible price is dominated by paper. Paper markets are dominated by leverage. Leverage is governed by margin. Margin changes punish weaker hands first. Sovereign liquidity needs can force real selling into moments of maximum fragility. A stronger dollar can add pressure even when the world looks worse, not better. Meanwhile, major states are showing signs of wanting physical control closer to home, and large institutions outside the West continue treating gold not as a meme or a trade, but as a strategic reserve asset. That is the real plan as I see it. Not some childish script where one villain pulls one lever. A larger structure in which the paper price can be smashed, the weak can be flushed, trust can quietly shift, and the patient holders of physical or long horizon exposure can slowly benefit from the very fear that destroys the impatient. That is why I do not ask first what the chart did this month. I ask who needed to sell, who was forced to sell, who could still buy, and who quietly moved their gold closer to home, while the public was being told everything was perfectly ordinary. That is how you read a market like this. And if you can read it that way, the next move may still surprise you in timing, but it will not confuse you in meaning. That is a tremendous advantage in a world where most people are still staring at the paper, quote, and calling it the whole story.